Okay, it says we are live. Woohoo! That's awesome. Okay, so welcome everyone to my live stream. If this is the very first time you're seeing this beautiful face, my name is Gloria, and I'm a YouTuber based in the province of Ontario here in Canada. And I create content for new immigrants looking to come to Canada so that they can learn from my experiences so that I can help you as well. So if you're looking to enjoy this kind of content, please consider subscribing to my channel down below and turn on your notification icon so that you'll be the first to know when I upload new videos. And today we're having a very special guest because a lot of persons have reached out to me saying, I want to know more about that video you posted about apartments and stuff like that and buying a home and things like that. So yeah, I do have a mortgage specialist in the building. Her name is, I'm going to allow her to introduce herself. I know her name is Christina, but she's going to introduce herself and then we're going to be talking about the topic you can see on your screen, first-time home buyer. So if you are a first-time home buyer in Canada and you want to learn what you need to know before you buy your first home, she would answer all of that question. And if you do have questions, please leave them in the chat box. We'll all get to those questions. So up to you, girl.
Oh, hi everyone. Welcome to Brown Sugar TV. Remember to like, share, comment, and subscribe to her channel. And yes, tell a friend to tell a friend. And now we're coming over here to blow up Gloria's channel. So my name is Christina. I'm an immigrant to Canada. I will no longer consider myself a new immigrant. I've been in Canada for almost 7 years now. I came here. Yeah, well, I won't tell you my age when I came here, but I came here very young, without any family, and I've made my way around. So just know that you can come here too, and you can make it. Um, right, I'm in Ontario as well. Right now, I'm located in London, Ontario. I met Gloria a few years ago. We were working for the same company. She has since moved on, but she's an amazing person, and I'm really grateful for the opportunity to be here on her channel and share my wealth of knowledge with you.
So, thank you, Christina. So you tell us more about the home market and all we need to know as new immigrants, because a lot of persons who are going to be on this chat today or on this live video, they're actually new immigrants, and maybe some of them will be those who are already here in Canada and kind of trying to weigh their options as to either to buy a home and what they need to know. So
yeah,
go ahead.
For sure. So when you're buying a home in Canada, there are many things to know about buying a home in Canada. There are lots of financial institutions that do offer mortgages to first-time home buyers and new immigrants. Specifically, well, I know of a company. It's called the Start Right Mortgage Program, where as a new immigrant, you're able to get a mortgage with as little as 5% down payment. There are certain stipulations surrounding new immigrants getting a mortgage. However, just know that you can do it. When you're buying a home in Canada, like the first thing to consider is the down payment. Where are you going to get that money from? Because unlike our neighbors across the border, you must have a down payment to put down on a property in Canada. The minimum down payment on any home in Canada is 5% if the home is below $500,000. So if you're buying a home for $400,000, you must have 5% down on that property. And if you're buying a home for $600,000, you must have a minimum of 5% for the first $500,000. So we're talking about $25,000, and then you must have 10% for anything over 500,000. So for example, if you're buying the property for 600, 5% of first 500,000, you're looking at $25,000, and then you're looking at 10% off $100,000. Then you're looking at another $10,000. So if you're buying a $600,000 home, you need a minimum of $35,000 down. Now, your down payment can come from different sources. Such as, you can come from your savings. So you can save in that money over time, etc. Your down payment could have also been gifted. So your down payment could have come from a family member, because those are who we consider to give gifts, such as your parent or grandparent, and occasionally like a brother or sister. But I always say, the banks, they tend to be, you know, very strict when it comes to gifted down payment. So like I always say, if your parents are going to give you money, or like an uncle or like a cousin who you grew up with is going to give you money, is to always have the money in your account at least 90 days before you're closing, just so you may not have to put those people through getting you a letter, getting bank statements to show where all of that stuff. It just becomes too tedious. So like if you could get it before 90 days before closing, better for you, and it's just like a lot easier for everyone. Another way which your down payment can come from, so if you come to Canada, you can open up what is called an RRSP, and you can contribute money to your RRSP, which does help reduce your taxable income. And then you can also take that money out, maximum of 35,000 back from your RRSP to use as a down payment. Now you have to pay it back over 15 years. But that way, obviously you're still saving for your retirement over time, and you have that money for your down payment. And again, it helps reduce your taxable income. Now that's it for the down payment portion of it. There is also, I don't want to get too technical, like if you've never purchased a home before, but like when you're doing 5% down payment, there is also what they call the insurance, like the home buyer's insurance, the CMHC, where you have to pay on top of like the down payment and everything. They normally put it on top of your mortgage, but you have to pay in Canada, everything is taxed. So on top of that, you have to pay the taxes up front, but the rest of it is added to your mortgage, and it's paid over time. And there are different lenders that do offer, there are different people that do offer the insurance, but most of the CMHC that banks go through to get that insurance. And it's tacked onto your mortgage. So if you put 5% down, your CMHC insurance is going to be approximately 4%. So technically, you'll only have like 1% equity in that property. And and then we talk about income. So as a newcomer to Canada, there are times when we have different streams of income. But even as a newcomer, you still have to meet the bank's minimum income guideline. So there are different types of income. So like if you've been working a part-time job, you must be able to show there are two options that you have when it comes to a part-time job. It's either your job is a permanent part-time, which means that you're guaranteed hours. So like you may be guaranteed 20 hours a week. Then that income, you don't have to have it for more than 2 years, because your employer you'll be able to show that this is a guaranteed part-time job. But not a lot of part-time jobs have guaranteed hours. So if you work at like certain places that pay like staff like hourly and stuff like that, a lot of them will not have guaranteed hours. And some week you'll be working 30 hours, another week you'll be working 20 hours. And then that doesn't really go for the bank. You'll need a minimum of 2 years income. So you'll have to be in that job for over 2 years, because the bank will then average out that income over 2 years to consider that. Then there's full-time employment. So full-time employment is generally like anywhere from 35 to 37 hours weekly. That way the bank, you can be in that job as little as 6 months, as long as you're past your probationary period and your employer is willing to write you a letter letting them know you've passed your probationary period and you're a permanent full-time employee. The banks will use that income. You don't need to be in that job for over 2 years for them to consider it. However, like if you do work overtime, like I've had this situation before where people are like, oh yeah, like I work 40 hours a week and I get like extra overtime. Like I get I pick up shifts on weekend. The bank will only ever consider your overtime income when you have been doing it for more than 2 years. So like if you have not been in that job for more than 2 years, we will not look at your overtime income. We will only look at your regular income. So we'll not look at your overtime income if you've been in for less than 2 years. Contract. So sometimes there are lots of companies who hire folks on contracts. Again, contracts, the bank will only look at contract jobs if you've been repeatedly contracted by that same company for over 2 years. So we'll only look at contract jobs if you've been in over 2 years. The only other way like that they'll look at it if you've been in less than 2 years is if like you're a physician. So like if you're a doctor, they know that you'll have guaranteed work over time, so they're not worried about it. So there are certain positions like, and some teachers also get hired on contracts, and the bank will look at it with less than 2 years of employment, because those people, they tend to get their contracts, renewed. So the banks will look at those things. The next type of income we have is like commission. So like commission sales income. So there are lots of people who do, like, they work at car dealerships and they sell cars and they get paid commission. Like insurance brokers, they get paid commission. Mortgage brokers, they get paid commission. That income, once again, 2 years. Minimum 2 years for the bank to consider looking at that. So you need to be in that for 2 years. And the bank will average out your 2 year to use that as your income. The same thing goes for when you're running your business. Now, like, I really wanted to highlight on the business. So there are people who start their own business, and they are like maybe like a contractor, or they're maybe like a lash technician, or like, someone who does nails, and they're like, oh yeah, like I make $150,000 a year. Okay, you make $150,000 a year, but you write off 100,000. So then on line 150 of your T1 General, your income only stays $50,000, and the bank doesn't care that you made another 100,000. The bank cares about the fact that, like, you only claimed after all your expense that you only make 50,000, and that's all we will use. So people get upset and they're like, why can't I get approved for that? And it's like, okay, you can't get approved because you're not claiming the income, and we go with what you tell the government. So that's another thing. It's a big thing that, like, if you're a business for self and you're looking to buy a property, make sure that, like, you're thinking of like what you will need that future income to show, and how much of a property that you would hope to get approved for. That's like all I have, like, in the sense of like income to really discuss. If anybody has any different types of income that they wanted me to touch base on, can let me know, and I can always come back to that. The other thing that, like, I wanted to talk about when it comes to getting a mortgage is debt. So debt is a big thing when it comes to getting a mortgage. So car loans, like credit cards, having like high credit card debts, lines of credit debt, those can deter the amount of a mortgage that you're qualified for. But one of the biggest deterrent on your credit when you're looking to get a mortgage is a car loan. So, like, I always tell my clients, for every $400 in car payment that you have, your mortgage affordability goes down by about $100,000. So, for example, if you were making like $100,000 annually, and you would have been qualified for a $400,000 mortgage, and you go ahead and get a car that costs you around $400 a month, you're not only qualified for a $400,000 mortgage. So, like I always say, like, if you're thinking of buying a home soon, get the car after. Car dealerships, they don't really care about your income like that. They just want to sell a car and get you in a car. So if you're thinking of, like, buying a home in the near future, don't go get the most expensive car. And, like, sometimes we have to get a vehicle to get around, but if that is the case, get the longest term. So, like, maybe if you get a 4-year car loan, the payments is $400. Okay, you can always make prepayments on your car loan. So get the 7-year loan if the car dealership will offer it to you. That way your monthly obligation is way less. Another thing is furnitures. There are lots of times when we have apartments and we really want a fancy apartment because everybody wants to live in the nicest place. But getting like expensive furnitures and having like a monthly furniture payment, that does deter your affordability when it comes to mortgages. So, like, you don't want to go and get your fancy couch after you have already purchased your home, get that big TV after you have already moved into your new home. Get all of those credit after you've moved into your new home. Another thing as well is that when you're in the process of buying a home, never, ever, ever, ever get credit. So, like, if you have, like, you've seen the house, you put in an offer on the house, and, like, today is May 14th or 13th, and you're going to close on that new home August 1st. Between now and August 1st, don't go out there getting a brand new car. Like, don't go out there getting, like, a new credit card, or like buying or like getting any sort of credit, because like you can lose your approval. Like until you have closed on that home and have those keys in your hand, do not, again, do not ever, ever, ever go and get any sort of credit. But that's like one of my little tidbits for today. And I'm opening the floor for questions.
So the first question here I have, it's you talked about gift letter. So what are the contents, or what should be in that gift letter if we're going to get a gift letter from a family member or something like that?
So generally, each lenders have their own gifted letter, and they will provide that gifted letter to the borrower to get the person to fill it out. So every lender will have like a different format, but they will have a format for you. So basically, the content of the letter says it will be like, I, Christina, I'm gifting Gloria $35,000 as down payment for this property. She will not have to repay it, and I do not have any interest in the property. So like, I'm not gifting you $35,000 to get 2% equity in the home. It is a gift, and you never have to repay it, and it's coming from my own resource.
Oh, okay, that makes sense. And then you said something about having funds in my account for 90 days. What does that really mean?
Yeah, so basically, once you're doing 5% down payment, lenders want to know the source of the funds. So they want to like kind of see where the money is coming from. If you've had the money in the account for 90 days, it's going to be assumed that it is your savings. And so it's good to have like that, have it in the account for at least 90 days. That way, you don't like they won't go above and beyond to go get any additional information on that funds in the account.
Okay. So somebody has asked a question, and I know from my phone here, it says that if I'm a newcomer to Canada and I don't have maybe a job, or I don't have reliable income, but I do have money from back home, can I still buy a home here in Canada?
Um, I mean, there's some private lenders who would still lend to you. I know you could not get a traditional mortgage from the bank. So back in 2018, the banks did change that. So back in 2018, it used to be that if you're a newcomer to Canada, if you had at least 50% down payment, you could still get a mortgage. But they have changed that now, and you need the income to be able to get the mortgage. But there are private lenders who will still lend to you, but they'll lend to you at like enormous interest rate of like 12%, 15%. So it's really, it would probably be a lot better. You'd probably be a lot better off to just wait until you get a job and you're able to get a traditional mortgage, because like those astronomical interest rates really, it's not like really worth it at the end of the day, right? Like paying 15% interest rate.
Okay. I have another question here. It says, what's the difference between having 20% down payment and 5% down payment on a new home?
Okay, so the main difference come down to, if you have 20% down payment, always do 20% down payment. So if you do not have the 20% down payment, and you have anything below 20% in down payment, you have to pay the insurance. So like the Canadian housing insurance, basically it helps to protect you and the lender in case of financial hardship. So like they have different tiers. So for example, if you do 5% down payment, you have to pay 4% of your purchase price as insurance. So doing 20% means that you avoid that insurance premium, and anything below that, you do end up with an insurance premium that you have to pay.
Okay. So one other question on here on the chat screen says, how possible would someone living outside Canada get a home through this means?
Get a home through.
So I believe, so if someone is living outside of Canada and they want to buy a house in Canada, how is that possible for them to do it? Must they be here in Canada before they can buy a house? I think that's where the question is.
If you have cash, you can always buy the house here.
Was that?
If they have the cash, they can buy the house here.
Would you recommend them to use cash to buy the house? That's another question.
The banks won't lend to you if you're not you can use foreign income, but that foreign income has to be reported to the Canadian government for it to be considered. So, like, for example, we have lots of Canadians within Canada who have, that's another type of income. We have Canadians who are within Canada who works for a U.S. company and they get paid in U.S. dollars, and they get charged like the U.S. tax. But the only way the banks will consider that foreign source of income is if they're reporting that foreign income as well to the government of Canada. If you're not reporting that income to the government of Canada and you're only filing taxes in the U.S. or like in Jamaica, then the banks won't look at that. You'll have to have your cash, or maybe a private lender would also lend to you. But again, private lenders' interest rates are like very hefty. So that's like the only way that you could really get it if you're like outside of Canada, is through a private lender or you buy the house cash.
So I don't know if it's the same question, but Funke Osisiami is saying, is it possible to use income from other countries? I'm sure you touched on that. I don't know.
Yeah, that's it. Like, you can, if you are claiming that income within Canada. So if you are reporting that income to the Canada Revenue Agency, yes, you can use that income. And again, foreign source income, it has to be for 2 years. So you must have been working for that, getting that foreign source of income for 2 years and reporting it to the CRA. And then the banks will use the average of those 2 years to consider it for as income.
So for a newcomer who's just come to the country and they probably don't have maybe like 2 years of income, what would they do?
So
They,
newcomers who just come to Canada and they don't have 2 years of income, it depends on the type of job that they have. If they have a full-time job, then it doesn't matter that they haven't been there for 2 years. So like if they have a full-time job and they've only been in that full-time job for like 7-8 months, sure, they can go ahead and still get a mortgage. They'll just need a letter of employment to state that they are in a permanent full-time position. If it's a part-time job, unless it's guaranteed hours, they probably will not be able to qualify for a traditional mortgage through an A lender. They'll probably have to go through a B lender or private lending. If it's a contract job, again, the same thing, unless you're a physician. Like, we have lots of doctors that come in here, lots of dentists and all those people, and sometimes they do get hired on contracts. The banks will consider those income with less than 2 years. Business for self. If you start your own business as a newcomer, you have to wait the 2 years unless you want to go through a B lender. So the top 5 banks within Canada, or top 6 banks like Scotia, TD, CIBC, Bank of Montreal, and RBC, as well as HSBC, they're considered A lenders. Also, like, you do have credit unions as well. They can give traditional mortgage with very, very low interest rate. So like when I talk about like getting a higher interest rate, like when you look at the banks, the interest rate right now, they're 2% and below. If you should go to a private lender, you're looking at 8%, 10%, 15%, as much as 20% that you're going to be repaying. And like 20% interest rate is really ridiculous. Like, you'll not pay off that mortgage ever. So it's not like you can't ever go to like a B lender, because over time, like, obviously, like, you can go to a B lender and wait for the 2 years to have that income and then switch your mortgage to an A lender. But sometimes it's like you can still rent for a little while until, like, you may have that income to really back you up, because you can go get an 8% mortgage and put yourself in like a really, really difficult position, right?
so is it much more better to get the mortgage through a private lender or through the banks?
It's much better to get it through the bank, because the interest rates are just way too high with private lenders, right? So like, there's some private lenders who will have decent interest rates. For example, MPAC, which is a lender within Canada for mortgages. But generally, like, those lenders, like, you can still use them. Generally, they have like lots of restrictions on their loans. So like, when you can pay it out, and there tend to be fees for every little thing. So like, if you want a mortgage statement, there tend to be fees. There tend to be fees associated with every small things within those companies. But again, it's up to you. Like, if you're really, really interested in buying a house and a private lender is the only person, unlike a B lender, is the only person who will give you the mortgage, and you really want to do it, then definitely you can still go ahead. You work your budget. If you can work your budget and afford an 8% interest rate, then for sure you can still go ahead with it.
Okay. Another question here is, what does it mean? What does the word amortization mean?
So amortization is the amount of time that it takes to pay off the loan. So within Canada, if you're doing 5%, if you're doing less than 20% down payment, the amortization is 25 years. So like that's 25 years. The bank is giving you this loan for up to 25 years to pay off this mortgage. If you do more than 20% down, if you do 20% and above, the bank will give you a loan for up to 30 years. So you get 30 years to pay off the mortgage, which does help with your affordability a little bit, because like obviously your payments will be less if you're borrowing 300,000 over 30 years versus if you're borrowing 300,000 over 25 years.
So what happens if I'm not able to pay in 25 years? Like I'm not able to pay off my mortgage in 25 years.
The loan will always be set up so that it's paid off in 25 years.
What happens if it doesn't?
It will always be set up that it's paid off in 25 years. Like the bank is going to give you the loan for all your payments will be set so that it is paid off in 25 years. Like they will not make your payments any less, so it will always end up being done. So a lot of people are done before 25 years, but it will always be set to be done in 25 years, and the payments are structured in the way that to make sure that it's complete.
Okay. Karine says, is it so bad to use the program the government has for first-time home buyers?
It is not bad to use the program. It is so basically the government do have a program where they lend you money for the down payment. There are restrictions with it. So, for example, if you go through a traditional program to get your mortgage, there are times when the lender is able to. So, rule of thumb that I always tell my client when you're considering like a mortgage, you can get sometimes up to 5 times your income for the loan, right? So like if you make 100,000, the banks may be able to stretch the your debt to income ratio so that you can get a $500,000 home. When you're getting the mortgage through when you're using the government program, where the government program is that they'll lend you up to 5% on a existing home and up to 10% on a new home, so like a new construction. The problem with the government is that there are restrictions. They will not lend you any more than 4 times your income. So if you make 100,000, they will not lend you. Your mortgage cannot be any more than 4 times that. And that the catch is that the government will give you 5% of the $400,000, and then so 5% of the 400,000 is 20,000. However, like if you either have to repay it when you sell the house, or I believe in 15 years, whichever comes first. So when you sell your house, let's say in 4 years, and your house is now worth 650,000, you have to repay the government 5% of 650,000 instead of 5% off the 4 or 500,000 that you were initially lent by the government. So that's the only catch. Like, I mean, obviously, like if you are in the position where you really need the government where you really need help to come up with the down payment, but you still have to have 5% from your own source. Like the government, like you still have to have it. So like, if you do have 5% from your own source, I'm not exactly like, I think you'd still be good to go ahead without needing the government, if you get what I mean. Like the banks, any of the A lenders would be able to stretch your income to help with that.
Okay. I just got another question here. Someone says, I hear you saying putting offer. What does it mean?
When you put an offer on a property, so like if a property goes up for sale and you make an offer to purchase it. Now in Canada, like there's like, I don't know, like 30 people putting an offer on one house. So like it's a very competitive market, and I can tell you that you may not get the first home that you offer to purchase. So basically, so when someone have their property up for sale, you may make an offer to buy that property. But it's a competitive market now, so you may be putting in like up to 5 offers before you ever get one.
Okay, I have one question here.
Sure.
Saying how how do I know how to put a price on a house? Like what I mean is, if for example the house is going on sale for 650,000, and they're asking for something different, what do I need to do in that situation?
So before you put an offer on a property, you need to get a pre-approval. So you need to go to the bank and get a pre-approval done to see how much you qualify for. Now, let's say, for example, you qualify for a mortgage of up to 800,000 and a property is listed at 650,000. Your real estate agent would be able to guide you as to how much you maybe need to offer this person to buy this property in order to be able to get it. So your real estate agent, the property may be listed for 650, and your real estate agent say, there's a lot of people who are looking at this property and there's probably going to be like 4 offers on it, so I think you should offer 700,000. Now, one of the catch with offering 700,000, which is I always tell my clients, is that you may offer $700,000 on that property, but the bank may not appraise that property at 700,000. So when you're looking to make above asking price, so for example, the house is listed at $650,000. That's what it was like maybe initially appraised to be worth, 650,000. Now, if you want to go ahead and make an offer for 700,000, you have to know where that additional 50,000 is going to come from if the bank only appraised that property at 650,000. So like you have to also be careful when you're bidding above asking, because if the appraisal doesn't come in that the house is worth 700,000, the bank will only give you money for what it comes in appraised at, not what you offered it to be. So like if you want to go ahead and put in above asking offers, you got to know, if the bank doesn't appraise it at this price, where am I going to get that additional 50,000 from? Do I have $50,000 in my pocket to go ahead and put that as an additional down payment on the property?
Great, great, great. One question just came in. Clients, someone is saying that I hear you saying appraised, appraised. What's the meaning of appraised?
So an appraisal is when someone goes out and basically determine the value of the property. So for example, like I said, you may see a house that is listed on the market for 650,000, and then someone goes out and look at the sale that have happened within that neighborhood, the size of the homes within that neighborhood, what they sold for, and then that will ultimately determine the value of your property. It's like, is it really worth 700,000, or because the reason why the bank does that is that the bank have to take into consideration, if you don't make your mortgage payments and we have to foreclose on this property, how much will we get if we put it back on the market? Will we get 700,000, or will we only get 650,000? So they won't lend you more than what an appraiser will go out there and say, this is the value of the home.
A follow-up question to that says, when do you know what the house is appraised at? Does the potential buyer have instant access to that information?
So I've worked with a really, really, really great real estate agent. I don't have her information on me right now, but one thing that my real estate agent does before I put in an offer on a property, my real estate agent sends me over comparable sales. So like, for example, like a property is listed at 500,000 in a condo building, my real estate agent will send me over how much of these condos sold for in the past. Like, how much did the unit next door that sold a month ago, how much did it go for? And my real estate agent will say, that building, all those other condos, they only went for 450,000, which means that this person asking 500,000 is asking for too much, and it probably isn't worth 500,000. So if you're going to make an offer on the property, you should make an offer at 480, because the bank may not see this building as being worth 500,000. Now, when my customers come to me and they say, oh, like I've made an offer on a property, and they bring me the MLS listing and they bring me the purchase and sale agreement to say they've made the offer, the first thing I do is I order an appraisal. I get my appraisals back within a day or two, generally. So I can let my client know within a day or two if the appraisal came in at the value that they thought it would.
Okay. So you said earlier on when we were speaking something about loans and lines of credit. So can you really expatiate, because you were saying that people shouldn't go get a line of credit or a loan if they're thinking of buying a house. If they already have that, how does that affect their home purchase?
So that can affect the affordability. I've had many cases where like my customers or my clients, they may have loans and lines of credit, and I've had to ask them to pay it off and close it before the mortgage is able to close. So like there have been times when it depends on the affordability. Like if you are like in a position where like your income is not as much as like obviously like where it needs to be, then there is instances where I've had to ask customers to pay off those lines of credit. For example, like I always say to my client, like your mortgage should not be more than 30% of your income, right? Now, for example, my client is just for numbers' sake. My client is taking home $1,000 a month, right? And they have like a $10,000 line of credit. I'm going to take into consideration what will that payment be if they should max out this line of credit, and I'll be using 3% of that number. So it is now $300. And now your mortgage is only supposed to be, by rule of thumb, only supposed to be like 30% of your income. So you should have a mortgage of a payment of no greater than $300. Right then and there, when you have that $10,000 line of credit open, and you have then now your mortgage payment is $300, right there, 60% of your income is gone. The bank will not lend you money when you have 60% of debt every single month. That is too much money. You haven't considered your property tax, you haven't considered your insurance, you haven't considered groceries, you haven't considered any other bills. So then right then and there, I would have to ask this customer to close this line of credit, because I wouldn't be able to give her a mortgage for $300 if she have another $300 in payments, and she will possibly have another $300 in payment if she should max out this line of credit, and she only takes home $1,000 a month. So that's one of the things that you have to consider. It's just like, how much are you taking home, and can this stay open if you should max it out and you still afford a mortgage?
Great. Thanks for that answer. The next one here is what's the difference between mortgage insurance versus mortgage premium?
It's the same thing.
So the mortgage insurance and mortgage premiums, like
it's the same thing.
Oh, okay. Yeah. Same thing. So you said something about condo, which brings me to a very interesting question, and this is my own question for you. What are the different types of homes that we can buy here in Canada?
Well, obviously there are different types of there is like single family home, duplexes, triplexes, fourplexes, condos, and the condo, like one of the things that I always say to my customers when it comes to affordability, if you come and meet me today and I do a pre-approval for you and you tell me that you're buying a single family home, I'm only going to take into consideration what your potential property tax may be, what the potential size of the home may be, and your potential mortgage payment. Now, if I give you an approval today for $400,000, but you end up going out and finding a condo, I now have to factor in condo fee. And that will make your approval less when I now have to factor in a monthly condo fee. So that's like the only downside of having a condo. Sometimes you may be approved for less if you end up buying a condo, because the banks will have to factor in that there is an additional monthly obligation that is there. And just to touch back on that mortgage insurance versus mortgage premium. So the mortgage premium is for like when you put down less than 20%. I'm not sure if this is the question the person was asking. And then there's the mortgage premium is there in case, it's called default insurance. In case you should default on your loan, there is that premium that you pay. And then there's mortgage insurance that lenders sometimes offer for like life, disability, and critical illness. I'm not sure if that was what they were like wanting to know.
Yeah, the person just said, credit protection on mortgage.
Yeah, so it is like life, disability, and critical illness. So a default insurance is there if you should default on your loan in case of financial hardship. So like there have been cases where, like, example, a family, the dad was a pilot, and the mom, they didn't have like other insurance, and they passed away. So they were going through financial hardship, and the default insurance, before they started to default on the loan, they were able to help them out with that. And then there's the creditor insurance on it, which is for life, disability, and critical illness, mean that if you should become disabled, such as like you broke your arm and you have to be off work for a few months, the disability insurance would help cover that. Then there is like critical illness, or if you should become critically ill, your mortgage would be paid out. And then life, if you should pass away, your mortgage would be paid out, and like the home would go to your kids or so. It is a great thing to have. I mean, insurance is that one thing that you always want to have, but hope you never have to use. But it is a good thing to have in place, because I always say to my clients, whether if you broke your arm, your bills are still staring at you. And if you have a heart attack and you survive it, your bills are still staring at you. So, they don't go away. You still have to pay that gas bill. You still have to pay the internet bill. Like, every bills are still there. The bank's still looking for its money. The bank doesn't care that you just were in the hospital for 6 months because you had a stroke. So it's a good thing to have, because like you never know what may happen to you.
Okay. Alex says, for instance, I have cash and I want a house in Canada, but I don't reside there in Canada. My gestation now. Is it possible to access a mortgage facility to get a house?
So if you have cash and you're going to be buying the house cash, there's no need for a mortgage person to facilitate that purchase. All you need is a real estate agent and a lawyer.
And how possible is it for that person to get the real estate agent and lawyer?
Very possible. They always want money. They're always willing to sell you anything. You just have to find a real estate agent that you trust and a lawyer that you can rely on that will help facilitate the purchase and will be honest with you.
Okay. This next question is, how would you explain it to a layman? When I mean a layman, somebody who is new to Canada, how can they kind of guess how much they can be afford for on their own? And that is part one. Part two would be, what is the meaning of GDS, TDS? So explain those two.
Okay, so the layman term, so like how much you're gonna get approved of, how much you're gonna get approved is basically how much you're gonna go into a bank with your income, or go to a mortgage broker with your income, and they will do a pre-approval for you, and they will let you know how much you are approved for. And now when it comes to the TDS and GDS, it's basically your debt to income ratio. So there is the total debt servicing ratio and then the gross debt servicing ratio. It's debt to income, right? It's how much money you make every month and how much money you are how much debt you have, like what's your monthly financial obligation. So you make $1,000 a month, and then you take home, and then you have monthly obligation of $300 a month. Your debt to income ratio is 30%. So that's basically it. How much are you making gross, or how much do you what's your financial obligation? That's basically it. That's just as simple as I can put it. It's basically what you make versus what you owe every month. And the bank only considered certain things, which is why a bank can bankrupt you. You always, before you ever go get a mortgage, you need to work your own budget. The things that banks do not take into consideration that we have as monthly expenses, the bank doesn't take insurance. So a car insurance, we don't factor that into your mortgage application. We don't factor in your grocery. We don't factor in your gas. We factor in how much your heat may be. We don't factor in your internet, your cable, and all of that stuff. So just because you make $1,000 and the bank say you can have a mortgage payment of $440 a month, you need to know, when I pay $440 a month for my mortgage, is the $660 remaining enough, or sorry, $540 remaining enough to 560? Is that 560 remaining enough to support me? Is that 560 enough when I pay $160 for insurance, and I pay $200 a month for grocery, and I pay another $100 a month for gas, and then I pay the cable and the internet and the phone bill and all of that stuff? Just because the bank say you can approve it, you need to work your own budget and say to yourself, am I really able to afford a mortgage payment of $440 after everything, right? Or am I leaving myself dead broke? That's one of the things that I think a lot of people don't take into consideration. The bank say, "Oh, you can afford it. You can afford 404." They're not your friends. Like, they will bankrupt you. They don't care as long as they're getting their money.
Not
And
your
if they're not
friends.
getting their money, they're taking the roof back from over your head because they're kicking you out of the house.
Yeah.
So you need to work your own budget and say to yourself, like, is this something I can really afford? So, like, that's one of the things too. Like, not only do you need to get a pre-approval, but have a budget and think about what's the maximum you want to be paying per month for mortgage.
Okay, next question. What's a good minimum credit score to have before you go in for a pre-approval?
720.
720.
Yeah.
Karen, did you get that answer? 720. So the next question I'm going to ask you, this is my personal question. I know I got this question from my last video. The lady had said, so if I'm coming into the country for the first time, would you advise me to go for a house, or would you advise me to go for a condo, or would you advise me to go get an apartment? I know you are a mortgage specialist, but what would be your recommendation for something like that?
So ultimately, it's up to you. Like, I mean, I've had customers who they've been in Canada for 6 months and they're ready to buy a house. It's up to your lifestyle as well. Like, you know, do you want to, like, can you afford the house that you really really want? And, like, you know, is a condo sufficient? Do you have three big dogs that need a backyard, or, like, you know, do you have multiple kids that need a backyard to go play in? So, like, you know, if you have the money and you're able to get the mortgage, it's really up to you what's your personal preference. Sometimes, a lot of times we come into Canada new, we may not be able to afford the type of home that we really really want. So sometimes it's okay to stay in an apartment and save up your money, and, or, you know, get that job that will you know, allow you to be able to afford the home that you're looking for. So again, it all comes down to personal preference. Not everybody has to own a home. Not everybody, but hello. As Black people, we need to own homes because, like, we have the lowest rate of ownership and the biggest wealth transfer is through real estate. So not everybody needs to own a home, but I think we all should. So
I'm getting this questions on here, but so let me just quickly say this. I'm going to leave Christina's contact information in the description box. And if you want more detailed, you have a particular question or you have a conversation you need to have with her, you're able to book her on Instagram. If you're writing down, you can take it down now. Her Instagram handle is at, you go ahead, girl. I forgot where
for
I
my
wrote it.
Instagram, so, like, you can reach me at xtina. So X is in xylophone, Tina, and Richards. So, like, my last name on the screen, but with two S at the end.
And I'm going to leave her contact information as well. So another question I'm going to ask you, Christina, is you said something about borrowing money and having to pay back. Can you explain what that RSP money is and why do I have to pay back my own money?
So the RSP is a registered retirement savings plan. A lot of Canadians use it as a way to save for their retirement, and then there are times when you're saving for your retirement, and you need to also access that money to be able to use as down payment. One of the reasons for putting money in an RSP is that it helps to reduce your taxable income. So, for example, if you make $100,000 and you put $10,000 in your RSP, your taxable income now becomes $90,000. So you pay less back in taxes, and sometimes you get a nice fat tax return. And the reason why you have to pay it back, or you don't have to pay it back, but the reason you should pay it back is that if you don't pay it back, you'll get taxed on it. So the government will ask that you put a minimum back every single year for 15 years. And if you don't put that minimum back, then, for example, like, if you borrow a certain amount and the government say you need to put $500 back every single year, and you don't put that $500 back, that $500 is now considered income for this tax year, and you'll have to pay tax on it. That's the only reason why you have to put it back, is because otherwise it will be considered taxable income, and you will pay tax on it, because when you had put that money initially in the tax free and the RSP, you were never taxed.
So if I have enough money to pay it all at once, do I have to wait for just making those minimum payments for
No, you
15
can
years?
always pay it back if you have the amount to pay it back.
Okay, that makes sense. Okay, the next question just went off my brain right now. I hope I can remember it again. So just one second here.
Okay, just one moment. Let me grab my charger.
Okay. So guys, if you do have any question while I'm thinking about that particular question from one of my subscribers from my last video, if you haven't seen that video, please go check it out. There I was talking about buying a home versus renting a home. So if you have a particular question on that, please let me know as well. So I believe you're back. Welcome. So the question I was going to ask in regards to home buying here in Canada.
Yep, I can hear you.
Okay. So what is this CMHC that you talked about? And you said 4%. I kind of missed that particular part.
So again, so that is default insurance. So that is something that you pay whenever you are putting down less than 20%. It is to ensure that the lenders get their money in case you default on the mortgage. It is, yeah, that is there to protect both you and the lender if you should fall on financial hardship. You can go through CMHC and explain your situation to them, and then they're able to, either work with you to come up with a financial plan, or, that's kind of it though. Like if you should fall on financial difficulties, they would be able to help come up with a strategy to ensure that the lenders still get their money and you don't lose your home.
Okay. So is there any incentive that the banks would offer? I know Scotiabank usually would have something for newcomers to Canada. Can you touch on that, please?
So there are incentives for newcomers. So for example, like, or I wouldn't even consider them to be as much incentive, but one of the things that like a lot of people like me run into with a lot of other lenders is that they're new to Canada, so they don't have credit. So they may not have if you're coming from a country other than the States, they may not use TransUnion or Equifax to report to credit bureau. So what the banks look for is when you're buying a home is they look at your credit score. So newcomers may not have a credit score. They may not have sufficient credit. So if you're a newcomer to Canada, the banks will bypass your credit by one, you can provide them with your landlord information, and your landlord can write a letter saying that, oh, this person have been a tenant of mine, and they have paid their rent every single month on time, and yada yada yada. Like you're able to get a personal reference letter in lieu of a credit report. Now that can be. Now that really helps for like a lot of people who they're new to Canada and they haven't had a chance to build up their credit. But that is only for the first 3 years in Canada. So if you've been in Canada for longer than 3 years, you must go get credit from somewhere. So you need to get a credit card because you need to build credit. And as long as it's past 3 years, that no longer counts.
So you're suggesting that they get a credit card at least to start building.
Card and start building your credit. Yes.
Okay, that makes sense. And can you also explain, because I know I made this video the last time and I got somebody asked me a question about closing costs. So can you kind of give us an idea of what those entail?
So closing costs is generally I generally factor in 1.5%. But for first-time home buyers, the closing costs will include things such as like your legal fees. So it mostly like entails like your legal fees and like if there are any other fees associated. Some of the times there's some HST fees that may be associated with it, but very rarely. If you're not a first-time home buyer, one of the most expensive closing costs you'll have is land transfer tax, but that's only like when you're buying your second property or a rental property or so, then there is that land transfer tax. But for your very first principal residence, you do not pay a land transfer tax.
Is that something that the government gives to newcomers or?
It's for newcomers and first-time home buyers. The land transfer tax, however, so like for example, if you come to Canada and you're dating someone who like was already in Canada and they have already had a home, and now you guys are buying your first home together, you don't get that land transfer tax.
Okay.
Yeah, you have to
Just
pay.
up first.
Yeah.
Okay, so what's the difference between the fixed and the variable rates?
So fixed rates is basically, like its name suggests, it stays fixed for the entire term of the mortgage. And variable rate is all dependent on what we call in Canada prime lending rate. So that's like the benchmark lending rate, and it changes from time to time. So with a variable rate, your rate will change based on how many times that prime that standardized lending rate changes.
Karen here on the chat screen says, is it possible to pay more than the specific mortgage amount? Does it work out better for you or it doesn't make a difference?
It works out better for you to pay more than the specified mortgage amount. So, for example, this is one of the things why sometimes private lenders, these are sometimes things that they do not offer. But like I know with the traditional banks, is that this is something that they do offer for most mortgages, is that you're able to make extra payments throughout your mortgage. So, for example, at Scotia, with our traditional like mortgage, because we have more than one different types of mortgage at Scotia, but our most popular mortgage is the mortgage where you're able to increase. There are things you can do to make pay off your mortgage faster. One, you can double up on your mortgage payments. Two, you can increase your regular mortgage payment by 15%. Three is that you can make a 15% prepayment, meaning that like if you borrowed, if your mortgage is 100,000 over every calendar year. So if you got your mortgage June this year, so between June this year and June of next year, you can do 15%. So that means you can prepay $15,000. So every month you can put $1,200 extra down if you like, as long as you do not exceed the 15,000.
The next question I'm going to ask you is, can I buy a home for myself and then still rent a portion of it, maybe the basement?
Yep, you can.
Is it allowed here in Canada?
Yes, it is. It is allowed in Canada. You can do anything you want with your principal residence. The thing about it is that there's times when like situation changes, but yeah, you can definitely have your home and rent it out. You can have a roommate. You can do whatever you want.
So we have different people that come into Canada every year. We have international students and we have those who have their permanent residence. What's the difference between these two category of people when it comes to buying or purchasing their first home? Is it the same or not?
No, it's not the same. So generally, foreign workers. Foreign workers, they need to have the maximum down payment, or the foreign workers, they also, sorry, my brain is kind of frying a little bit on that one, but permanent residents, they go through the regular program. Foreign workers generally, they need to do 35% down. So they need to do the 35% down. They may also be able to do the 5%, but I believe it's like either that you do like the below 20%, but if you're doing above 20%, it has to be 35%.
What about international students? They can't.
International students generally don't have jobs.
Yeah. Sorry, international students.
Generally, like your work permit only stipulates you to be able to. International students can't even get a line of credit because your work permit only stipulates you to work so many hours. Mm-hmm. So like it becomes like a lot more difficult for you to actually. And I mean, if you're working 20 hours a week in Canada, chances are you're going to be having a minimum wage job making like $14 an hour. And there's not much you can afford with that.
Okay. Is it better to have a line of credit, like a secured line of credit versus a mortgage?
No, because the rates are always going to be higher on the line of credit.
The what?
The rates are generally higher on the line of credit.
But the advantage of that over the mortgage?
There's not much advantage on that over the mortgage because, like, first of all, interest is calculated daily on the line of credit, which there's not really an advantage because as long as you have advanced that line of credit, your interest rate is much higher. So like at 2.95, because like the general interest rate is prime plus a half. So at 2.95% versus if you can get a mortgage of 2%, there's no advantage on using a line of credit versus a mortgage.
I know I do know of some persons who would say, I prefer to have a line of credit because it's revolving and then I can have access to that money in the future if I need to do some home
So, so
rentals
most
or stuff like
mortgage,
that.
so like with, for example, with Scotia, and I know with TD as well, they allow you to have like a home equity line of credit. So it is something like that is set up in addition to your mortgage. So for example, um, I'll have a home and the home is valued at 500,000, but my mortgage is only 200,000, and I have a $50,000 line of credit, which is not advanced, but I still have my $200,000 mortgage, and that $50,000 line of credit is there in case of an emergency or in case I need it. But I'm not going to have a $200,000 line of credit and paying 2.95% on a $200,000 line of credit when I could have gotten a mortgage for 1.5%, right? Because it's just too much. So you can have a line of credit in addition to the mortgage.
Okay. Thanks for answering that question for me. There's one other question that I do have. Um, I don't know if you've answered this question before, but it has to do with the payment. So, what is considered an okay payment for a mortgage?
It all depends again on budget. So you need to work your budget, and the payments will be based on. So, for example, like I said, the banks will give you a mortgage for either 25 or 30 years, and then the bank will give you the payment schedule. So the bank is going to make sure that this mortgage is paid off in 25 years. So they're going to give you an amortization and the payments that will ensure that the mortgage is paid off in 25 years.
Okay. So can we reduce our amortization then or no?
You can, but that will mean that you're paying more.
Oh, okay. So you're paying more by reducing the amortization. But if it's 25 years, for example, it will just be that amount that you're paying every
Yeah,
time.
yeah. And if you want to reduce your
Okay.
amortization, and then there are other ways you can reduce your amortization to pay your mortgage off faster. So another way is you can pay bi-weekly instead of monthly. That helps reduce your mortgage term.
So is it better bi-weekly or weekly or monthly?
Again, it's up to your budget.
Oh,
So,
okay.
so most people get paid bi-weekly, so paying bi-weekly is no issue. You know that like your mortgage payments is going to come out every time you get paid. Some people get paid monthly, some get paid semi-monthly. So paying bi-weekly, when you pay bi-weekly, you end up making 26 payments per year. So that means that you're paying an extra month of mortgage every single year. So generally, like if you have a 25-year mortgage and you're paying bi-weekly, you'll pay off that mortgage in around 22 years and 3 months.
Great, 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 great. I'm enjoying this session already. So some persons on here are thinking maybe in their mind, it seems it's very easy to get a home here in Canada. What would you tell such people?
It can be easy. Like, I mean, to be honest, now it's very, very, very competitive because the supply is not catching up with the demand. So there are houses that go on the market and there's 50 people who wants that one house. So there is not enough homes in Canada to meet the demand of how many people wants to buy a home in Canada. So I mean, it depends also like on the area that you live in. There's some markets that are hot. There's some markets that are hotter than others. I mean, I bought my first place last September, and I put in maybe 5 offers before I was able to get one. So some markets are hotter than others. Like I know of people who have put in like 15 offers and haven't been able to get one. So it depends on the market that you're looking into. That will like kind of dictate how it really works for you. But
Exactly. Is it better to have conditions on your mortgage?
on the offer,
You're on the offer, yeah.
geez, to be honest, because the competition is so tough, that is why it's so important to go get pre-approved. You go get pre-approved because like lenders, a seller is probably going to give the property to somebody who doesn't have any conditions because they don't want you to have a condition for financing. Because if you have a condition for financing and then there's somebody like, for example, you put in an offer for five, the house is listed at 300,000, and you put in an offer for 400,000 with condition of financing, while somebody may offer 380 with no conditions, all cash, they're probably going to get it before you.
Yeah.
Because the seller is going to be like, well, what if this person goes to the bank and then they can't get the loan? Then I'm out of like selling the property. So I need somebody who have no conditions. So it's dependent.
Okay. So how would you summarize the topic, first time home buyer, what to know before buying your first home?
Get your credit in line. Go get pre-approved and have your down payment ready. And that's really it. And try to reduce having debt as much as possible while you're doing it. So that's really it. Make sure your credit's good, your income is within line, and you have a pre-approval in place and ready to go.
And I know you mentioned this before. You said Black people need to get home here in Canada.
It's one of the biggest wealth transfer, okay?
I like that. So thank you so much, Christina. I know you have other things to get to today. And it was a pleasure having you on my channel.
Talking to you guys today.
Yeah, thank you for coming to share this valuable information with all my subscribers and the new ones as well. So thank you. We do appreciate you coming in. And for sure, if you want to remind us of how to get in contact with you, that'll be good.
So you can shoot me a text. I'm happy to chat. And if you're ready to buy your home, I'm happy to help you get pre-approved today. So you can shoot me a text and we can start the pre-approval process. Again, my number is 519-691-7905. You can catch me over on Instagram. It's Christina Richards with 2 S at the end, Christina. And yes, it's happy to chat with you guys, and I will catch you next time.
Awesome. Thank you for coming to my live.
Thank you.
I do appreciate you. All right, guys. So thank you so much. It was nice to have everyone come join this live session today. I had a very wonderful time with Christina. And yeah, you see, it's always good to be good to people. I worked with Christina, so she's a very nice person. And I know she has a very good zeal for mortgages. So if you're looking to buy your first home and you need somebody to walk you around, be sure to hook her up. I would leave the description box her contact information. Like she said earlier on, she is on Instagram, and I would also leave her contact number where you can send her messages if you are here in Canada. If you're outside of Canada, you can also send her a message as well. It depends on your the telephone company. They might charge you for sending messages, but yeah, you have to figure that out. So if there's any question that you have about home purchase here in Canada, please don't forget to leave them in the description or in the comment box or chat box, and I'll send those questions down to Christina because she's the expert. She's the expert there. If you've been watching this, please don't forget to give this video a thumbs up. Like this video. It's very important that you like my videos, because when you do so, YouTube will share my video to other people as well. And if you've watched up until this part, Gloria, English is difficult. If you've watched up to this part and you haven't yet subscribed to my channel, please go ahead right now and hit that red subscribe button below. And please turn on your notification icon so that you will be the first to know when I upload new videos. And it was a pleasure sharing this knowledge with you all. I'm sure that you learned something today. I don't know what's wrong with me this afternoon, but yeah. I hope you learned something today, and you can tell a friend to tell other friends about this particular video so that they can come back to rewatch the video. And if you felt tired during the live stream and you want to go back and watch this video to understand what the specialist was talking about, you can always go back to my channel, and the video will always be there. It's for public view, so you can always go back and watch this video again. So once more, I'm going to say thank you very much for sticking with me and for believing in me, because I'm going to be bringing more guests to my channel. If you have a video request, please do well to let me know in the comment section, so that your wish is my command, but something that I can do. Don't tell me to do something that I cannot do, because possibly I wouldn't do it. So I know a lot of my friends are watching this. So thank you so much for sticking with me and for subscribing to my channel. Please, if you haven't subscribed, I believe you. Please do that right now and tell your friends to tell their friends to tell their other friends that yes, they can buy their first home here in Canada. So until I see you in my next video, which will be very, very soon, stay safe and God bless.